and welcome to Study Time with Steve. I'm Rachel. I'm going to help lead this a little bit today. I'm here for emotional support. We got Steve and we've got Kerry. We're going to have a great conversation today, so we're excited. And please feel free to leave your cameras on if you're comfortable with it. We love to see everybody's faces. This is supposed to be more of a group conversation. I know Steve and Kerry have some information to share at the beginning. And then we want to open up for questions and have some dialogue about the markets, what's going on. And I think it'll be really fun. So I will first, Steve, pass it. Can you pull up our disclosure slide? You
Can
are
you guys
not
hear me?
muted.
All
We're
right.
live.
I see some names out there, and I want to give a shout out to, hey, Tom McKinney, good to see you up there in Woodford Heights.
All right, Kerry.
Here today.
All right, Kerry, you ready to jump into it?
Yeah, but I want to start with something fun first. So I don't know, you guys can see my background here. I could move my camera around a little bit, but I want you to notice that I have more pictures of my dogs in my office than of my kids. So I don't know if that tells you anything about how my family is. Sometimes they like to give me a hard time, but I got my 3 mutts in the background here. And something else exciting
Lily
for
somewhere
me.
there too.
Huh?
Yeah, I can show my dog too. I have one.
Yeah, right. Yeah.
Don't
See,
wanna-
and on the wall, you don't have any of your kids either,
I
right?
don't have any. My kids are on the other side.
Okay.
But
Right,
yeah, my dog is always there.
right.
The first slide I wanted to bring up is kind of tooting our own horn, I would say. So this is a chart of stock to bond mix basically over the last 30 years. And it shows that, you know, in times of stress in the past, what has happened is at the wrong times, investors have been completely on the wrong side of where they should be in terms of equity to bond mix. And so, you know, I would say the average portfolio here at KWB is about 60% stocks and 40% in bonds and cash.
Or even higher.
Yeah, or even higher. And now you can see that, you know, let's go back to 2000, March of 2000, equities at their highest, you know, level in a very long time. And then go back down to February of 2003, and it's at its lowest, 40%. And right probably when you wanted to be more exposed to stocks than to bonds. Let's go to 2007, same thing. We're at 63% in equities at the top and right at the bottom. I mean, February of 2009 is the bottom, and you get a bottom in stock percentage of 36%. And so now let's go through the next, you know, 15 years or so from the bottom in 2009, and we've been pretty steady through the last time frame, which is really great for investors because that's where you want to be. You know, luckily we haven't had a ton of volatility like we had through the 2000s, but this is done by Vanguard, and what they said is that the reason that they believe that this is the case is that more and more people are working with advisors. And so advisors are giving people the right advice at the right times so that their equity percentage is not dipping at the wrong time.
And I think one of the biggest things we have to do as advisors is help people, I guess, put risk in its right perspective. You know, I always say, well, people, well, I don't want to lose money, or I always say, well, how do you define risk? Is risk volatility, or is risk losing all of your money? And then the other thing I always hear sometimes is, well, hey, Kerry, I really don't want to invest now. I want to wait till things get better. And it's like, okay, so you want to wait till prices actually rise. And so, you know, the market has the least amount of risk when it's at its lowest price. And I think sometimes people get a statement like, oh my goodness, the markets are down, you know, maybe something's wrong and I better do something. Yeah, you're probably right. You ought to do something. You ought to add to your portfolio.
Yeah, right.
Because the very best time to add to the portfolio is when you're probably most uncomfortable. You know, so today when you look at these equity versus fixed income allocations, you know, I'm actually pretty optimistic. And I think looking forward, you know, I'll go at least a year, is I just don't see a recession in sight. I think for the first time, you know, bonds do have more opportunity from here because we're starting at a higher interest rate point. You know, the 10 years probably what, at 4.4 or 4.5, something like that. You know, 2 or 3 years ago, you got paid nothing almost in bonds or fixed income. So the good news is here, finally, you can diversify your portfolio on stocks and bonds And in the bonds and in the fixed income, we can actually, earn something for the first time.
Yeah.
So yeah, I think Warren Buffett says it nice, be greedy when people are fearful, be fearful when everybody is greedy. And I don't think everybody's greedy yet. The market today, I think, is almost touching 5,300, Steve.
Yeah.
Is that a new high?
It should be. Yeah, I think so.
Yeah, an all-time high. Yeah. So
yeah, I mean, just one more quick thing on this chart is, look at 2009 again, and what you should be doing in those time frames is rebalancing back. Let's say you are a 60-40 investor, like it seems like most people are. If you look at this chart, you should be rebalancing back. I mean, you shouldn't be at 30. You should never get to 36. I would say if you get to 50, it's time to rebalance back to 60-40. If you get to, if the market keeps going down, keep rebalancing back, because it's going to bounce back and you want to be involved when it does.
And that sounds like it's going to address our fourth slide later on in this half hour here or whatever.
Yes,
yeah, you should.
All right, let's go to the next one. So, there's a lot of turmoil going on geopolitically. We've got the Ukraine war. We've got now the war in the Middle East. And I just wanted to bring this slide to everyone's attention because it always comes back to questions of, well, what does this mean to the market? And I think sometimes geopolitical events can affect the market, but in the grand scheme of things, it doesn't seem like it's a big effect. I think most of the time when we have effects of geopolitical events, it tends to be in times when we're already in recession, or in those timeframes where things are already bleak and then something else happens to exacerbate a loss. But in the grand scheme of things, if you wait a year after something happens, the market does what the market does, and it tends to go up.
Yeah, and I'm a major believer in the fundamentals. It's like you look at Yom Kippur, and I think that happened. Was that in the 70s?
I think so. Yeah.
And you go back and say, well, there's the worst case, Yom Kippur's. Look what happened. Well, there were a lot of other things happening back in the 70s. We had high inflation, we had high energy prices. So was it really the Yom Kippur War, or were that all the other things happening, at an economic level, that was driving this? So today, we have a lot of things out there to be worried about. We got the Ukraine war, we got an upcoming election. We have, the Gaza and Israelis and the issues there. But, when you come back and you look at home here in America and you look at things, there's a lot of reasons to be fairly optimistic here. We've got a solid housing market, and history tells us so goes housing, so goes the economy. We have a Fed that's kind of pausing, and historically we say, don't fight the Fed. So the good news is the Fed is more likely to lower rates from here. And so in spite of some of the other stuff happening out there geopolitically, coming back home, things look pretty good. And I would say this, because I don't think we have an interest rate slide, but I think we're going to have higher for longer. And I think that, there's no need for the Fed here to lower rates anytime soon. The economy is doing just fine. In spite of higher rates, housing, like I said, is still holding on. The economy still is doing good. The job numbers are still looking great. Anybody that really wants to work can. So I think this geopolitical stuff makes interesting news. I don't think it ought to be the deciding factor how you allocate your portfolio. You need to look back more at fundamentals and what's going on here. And yeah, sometimes things will trickle over, of course, but I don't see that happening anytime soon.
Yeah, the big one, let's just look at the Ukraine invasion. Yeah, the market was down, but what was going on during that time? We were going through inflation. Now, partially driven by
raising
Ukraine.
rates.
Yeah.
Fed was raising rates.
Right. But partially driven by Ukraine, some of the things happened in there, but it was, it really had to do with fighting inflation. And now that we seem to be past it, look, if we extended this chart past 1 year, obviously things have gotten quite a bit better. So,
right.
The other one that I lived through, 9/11, market was down, but we were also in the time of the tech crash, the tech crash of 2000. This just exacerbated that as another geopolitical event. So I think you're right. It just comes back down to what are the fundamentals of the companies that you're buying? Can companies either pass along what's going on to the consumer, or our consumers just kind of like, yeah, like you said, it's good headlines, but to me, I'm going to go and live my life.
Right. Yeah,
Yeah.
Quentin said something the other day. It's like, I think we're going to have a even election. I don't know if we have a slide about the election. I don't think we do.
No.
But, it's like, come November, we're going to pick a president. One of these two guys are going to probably be the president. And, half the people on this call might be happy, and the other half might be sad, or vice versa. I don't know. But, at the end of the day, on Wednesday after the election, most of us are going to get up, go to our favorite coffee place, do what we do, go see the grandkids, take a trip. And we might not be happy about the results, but most of us are still going to go do the same thing, right? And life goes on. And so that's another thing, is like looking more at the fundamentals of this economy than maybe the political infighting and stuff like that. And it certainly makes, I would say, depressing news. It's not very uplifting. And so, for me, I tend to read the news and not get as impacted by that, because I try to come in here every day with a clean slate. I don't want to be, whether overly optimistic or overly pessimistic just because what I see and read on the news.
Yeah,
Again,
it's
look back at the economy.
I saw a study that basically asked, how are you feeling about your own situation, and how are you feeling about the overall economic situation? And invariably it was, the economic situation, I feel terrible. The economy sucks, but my situation's fine. Everything's great. So if everybody's answering that the same way, that means the economy is probably doing pretty good.
Right. All right, let's go to the next one.
Yeah. This is yours, so you go.
Yeah. So, they always say past performance doesn't guarantee future results. And so for those of you, we got the S&P 500, and the S&P 500 are these big companies. It could be Coke and IBM and Johnson & Johnson and Costco and NVIDIA and whatnot. And when we buy into the S&P, there's two different ways we can do it. We can go into a market cap. In other words, Apple and maybe NVIDIA and maybe Tesla at some point in time were really, really big, fast-growing companies. And they became more of the whole market cap, right? Because these 7 companies or so were like 26, 28% of the S&P 500, wasn't it, Steve? Is that about right?
Mm-hmm.
So that meant the other 493 companies only represented, maybe 72% or something like that of the S&P 500. So we would call that market cap. And what happens in a market cap is, as these companies get bigger and bigger and bigger, you own more and more of them, right? So as Apple goes up, they're a bigger percentage, you buy more. And it's really more about a momentum trade, because what seems to work keeps on working and you're piling in. The other one that you see is the equal weight. The equal weight is kind of like, what? I'm going to buy all 500 companies and I'm going to own them equally. So if Apple really goes up, I'm going to sell a little bit of Apple and rebalance back to the other companies so that I maintain my equal weighting. So it's interesting when I look at the pictures there. I was kind of looking last night and I wrote a few things in here. And it's like, so the green is when the market cap is outperforming. So in other words, it's that momentum, it's that technology. So you look at that slide, you see 1990, I don't know, maybe 4 or 5. And then you see all green until almost 2000. Well, folks, that was the tech bubble. That was the internet coming full stream, and everybody was piling into Microsoft and Intel and Cisco and companies like that. Then we finally had the tech bubble. So then people started diversifying out and say, well, boy, it's not all about tech. And they owned other things and more utilities, banks. And then you'll see for it's like 6-7 years, where the equal weight outperformed. And then it was the market cap, and then the equal weight, and then the market cap. And you can see the trend. So what you'll see here lately is that the momentum trade has been working. Market cap, get on those big names and keep winning, and they keep going. The question is, when does the equal weight start to favor? And what this is showing you here is that the equal weight actually over time outperforms the regular market cap. And so, Steve and I will go back and forth and have some friendly discussions, because right now a lot of the portfolios have the market cap S&P in them. But one way to sell high and buy low is to start moving to the equal cap. you know, because then what we're doing is we're taking some money out of these big companies like Apple and Nvidia and Tesla, and we're spreading it across the board, and we're buying other companies that maybe haven't done quite as well. So, you know, when you look at performance, it's, you know, it's really kind of interesting because equal weight today really has underperformed market cap. And I don't know, Steve, if you have that statistic, but roughly what's the number when you look at the last maybe year or two?
I have the numbers going back 5 and 10.
Okay.
So 5 years, the S&P, the market weight has done.
So let me interrupt. I always like to interrupt. Sorry about that. But so just think for a minute here. We own exactly the same 500 companies, right? We just own them a little differently. So we own the same 500 companies. We just own them a little differently. Now tell me the return.
Okay. So last 5 years, market weight is up 15% annualized, and equal weight is up 11.8 annualized.
So almost a 3.2% difference. And that was 5 years?
5 years. And so and then over the last 10, market weight is up 12.7 and equal weight up 10.4. So the momentum trade has been strong over those that time
last
frame.
10 years. Yeah. So I'm a contrarian by nature. So me personally thinks that, you know what, one of these days I ask, well, who wins the most? Is it AI and NVIDIA that creates the technology? Or is it the Caterpillars and the Cummins and the other companies out there that get to benefit from the technology? And so even here, we're starting to use AI in conversations with clients. We're recording them with permission. And what the AI does, it actually takes the conversation and condenses it into notes. Now, we still have to take those notes and kind of clean them up a little bit. But, you know, Rachel and Kerry and all of us advisors will often spend 10, 15, 20 minutes completing notes about our conversation to document it. Well, now all of a sudden, you know what, we got a really good starting point. So who benefits most? Is it NVIDIA or Amazon Cloud because they have what do they call it at Amazon? Amazon Web Services?
Yeah, Web Services, yeah.
Yeah, or is it KERRY and KWB Wealth because we're able to take that technology and really be more efficient and whatnot. So I'm a little contrarian, and, you know, Steve, I keep thinking it's time to be thinking more about equal weight than market weight.
Sure. The one thing that I dislike in creating portfolios is doing something that you're trading. You're moving back and forth and you're saying, at one point, I like this way of investing, and at one point, I like this other way of investing. I would rather, there are lots of ways to skin this cat. You can own large cap companies in different configurations through a lot of different vessels at this time. So I think there are different ways of skinning the cat of how to invest in large cap companies. Now, think about equal weight. Equal weight is every company is 0.2% of that index. And so, and it rebalances every quarter. So if you get a company that's doing great and it becomes 0.5% of that index, it immediately is going to go back to 0.2.
Right.
Now, think about that company that was 0.2 in the market cap weighted, who then becomes 1 and becomes 2 and becomes 3. And what I always love to say to everyone is, if the market's down, just wait longer. Same with companies. When companies become larger and larger parts, that momentum actually does help you over time.
Right.
And so I would just be more in favor of using a different vehicle to skin that cat and just staying invested in that for the long term, as opposed to, well, right now I like equal weight and right now I like market weight. Yeah.
So in contrarian, would we have equal weight?
We could.
I mean, that would be a way to,
that would definitely be a way to be contrarian. Right. And again, the other thing about equal weight is it tilts to smaller companies and it tilts to value companies. So if we looked at that chart again, you know, what really did well in those timeframes was value and smaller cap companies. And so in our contrarian model, we do own a lot of value. Right. So that is what we're doing there, is having that value tilt.
Right. Well,
Yeah.
and in portfolios, we own large cap growth and we own large cap value, which is a way of getting back to the equal weight.
Yeah, right.
So
Yeah,
we've
pretty
skinned the
much.
cat a lot of different ways. Yeah.
Totally.
Okay. So let's go to my next slide. My next
Okay.
slide is one of my favorite. And, it's kind of like, remember I asked in the beginning, well, what do you define as risk? Is risk volatility? So this is one of my favorite charts, and what it goes is all the way back to 1983. So that's like 43 years of history. And what it shows is in the gray bar, it shows if you left town on January the 1st and you came back December the 31st and you open the newspaper, what it would show you is, hey, this is my return. So 1980, you left on January the 1st, you came home on December 31st, you opened up your statement. Wow, it's a pretty good year. I'm up 26%. That's great. But during that year, what this little red dot shows is the intra-year decline from the peak. In other words, during the year, the market actually fell 17% from its intra-year high. So if you get too nervous about the day-to-day things, then you would have not captured the whole 26% return by the end of the year. So a couple interesting things here is there's 43 years of history. And I don't remember the exact number, but basically, well, 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. So roughly almost 22% of the time, the market's negative. It ends negative. But that means almost 78% of the time, the market's positive, right? But to live the 78% of the time, you do have to go through those ups and downs. It is normal. And I don't know what happened to that other number, Steve, but it's normal for the markets to, on average, decline. I think it's 14% intra-year. So all the red down there at the bottom, if you averaged it out, 14% decline during the year is normal. But if you'd have just ridden it out, closed your eyes and taken your vacation, I think you'd averaged around 11%. That's what the gray bars would have averaged out. So if you were a person that wanted to gamble cautiously, and you knew the odds were 72% of the time you're going to win, right? That's a pretty good bet. And so that's where we go back. And, the worst case here, of course, was the great financial crisis, or I'm sorry, the tech bubble, 2000, 2001. And part of that wasn't just the tech bubble, because very quickly thereafter, we had the 9/11 tax and a few other things going on. But, volatility isn't risk. Volatility is merely the price, what people are willing to pay. What we have to do as investors is behave properly. When the red is showing up, again, the signal that you need to teach your mind is this is not the time to sell. This is the time to add, especially if you believe and you're an optimistic person. And for me, what I have to do is remember this is every time we've had a downturn, it's been followed by an upturn. Every time we've had a recession, it's been followed by an economic expansion. Every time the real market has gone down, it has come back up. It's the people that do things silly during those periods of time that hurt themselves. And it's also making sure that you have the power to stay the course, So that takes a little bit of economic preparedness, takes a little bit of, self-talk, talking yourself into doing the right things, because sometimes it's hard. And then that's where Mike and Diana and Kerry and all of us come in and try to be a good economic coach. We spend a lot of our time not just talking economics, but psychology, helping people do, the right thing when there's other alternatives that seem more appealing. Yeah.
I think it's funny that you're such an optimist when look at the year that you got into the business. 87. So the market
Crashed
down
25%.
34. Yeah. Declined 34% to intra-year. Most of that was the Black Monday, right?
Mm-hmm.
And then, but the year was up 2%. So
yeah, it's hardly a blip when you look at the calendar there. Yeah. We're down 34, right? Yeah.
Yeah,
up
but
2%
up 2, but up 2 for the year.
Right.
So it's just one of those things, that what a teaching moment to live through that year. Versus, some of these other years, like let's go to 2000, the COVID year, down 34, also up 16. So it's just really difficult to predict what's going to happen. The other thing to look at on this chart is how many years are down, have a decline of less than 5%. 2 years, that's it. I mean, everything else is at least a 5% decline. And, my favorite quote about declines is every decline before they happen seems like it's going to be the worst thing that ever happened. But every decline looking back was the best time to buy
Yeah,
stocks.
it's an opportunity, right?
Exactly. So I just think it's one of those things we got to keep that in mind, is that you don't go to the sale at Best Buy or Home Depot, and if they raise the price, you're like, oh, now I need to buy it. You want it at the lowest price possible.
Right. Yeah. So I think we're going to go into questions, but I just want to maybe just wrap it up with just my thoughts here. So as we look forward here, I think we still think we're going to have a pretty good 2024. We don't see a recession in sight. I think the Fed will probably, like I said, maybe October, maybe September. I wouldn't be surprised if it's not till next year that the Fed actually lowered interest rates. I think what they don't want to do is lose the momentum that they have and actually lower rates too quickly. Inflation still is a little bit of a problem. So that's bad news for homeowners or home wannabe buyers and things like that. But I think it's way better for the Fed to, be cautious, wait for the right information and then make those changes. There's a lot of interesting statistics, and I'll rattle them off and then we'll go to questions. And Steve, you can correct me, fact check me, but whenever we've had a January and February, like it has been in positive, I think over 2% each month, the 85% of the time, the market's been up about 14% by the end of the year. In election years, markets tend to outperform non-election years. Don't fight the Fed. The Fed's on our side. Housing is strong, and the consumer's doing okay. I think the only thing that worries me is the debt. And at what point, but that's worried me a long time, right? And so, there's news out here recently about how, big the debt is, and there seems to be no appetite on both the Republican or the Democratic side really to deal with it. And the reason is because about 2/3 of the debt, or what we spend, is in two programs. It's called Social Security and Medicare. And so neither party wants to deal with that because it's not popular with all of us on this call, right? Don't cut my benefits. So that leaves them only with 1/3 of the budget to really try to figure out, how do we, reduce spending? What do we do? And so that's why it keeps getting kicked down the road. And I think you're going to hear very little about that in this upcoming election. So with that, questions, or Steve, do you have any other comment?
No questions. Let's go for it.
Yeah, let's open it for questions. And if anybody wants to speak up, go ahead. And so while you're formulating your thoughts, someone asked, does the market cap versus equal weight index outperformance directly correlate to growth versus value outperformance? Is there an even better way that is still indexing?
Yeah, there are definitely other ways. There's a few products out there, like there's growth at a reasonable price is something that we know in the industry. There's an index for that. So basically looking at the growth of the company and using some sort of price, either it's price to book or price to earnings, whatever it is, to gauge if that stock, if you should buy it now or if you should wait till the price is at more reasonable. So that's a very good way to go about it. There's also ETFs that are tied to a style like Warren Buffett, and we all know, but Warren Buffett's done a really great job of investing money over the long term. So that's where I come back to. You don't need to necessarily have those two binary choices. There are other choices out there, but going back to the question of, is it a function of growth and value? I would say yes, because the equal weight is very value tilted, because you're just getting rid of a lot of those large growth names that are at the top of the index at this point. Now, it could be down the road, let's say 20 years from now, that value companies dominate the index. It's very possible that happens. Banks, you never know.
Utilities,
yeah, you never know what could happen. But
Right,
that could definitely be a thing. And then equal weight would be more tilted towards growth, because you're tilting that way. But in the grand scheme of things, yeah, at this moment it's very value tilted.
Quentin, you want to ask your question live? And then feel free to take yourself off mute and ask
Trying to stump us.
My question was, so May is almost, well, not almost, we're halfway through May. It's May 15th. There's the old adage that you should sell in May and go away. What are your thoughts?
I think I'll go to Canada.
I just saw an article about something, just basically jargon that we have in the industry, and the one of them was sell in May and go away, and he said what the real meaning of that is, I only invest based on things that rhyme. So he also said you should what was it, buy high and something else, there's just, if you look at the long-term averages, I would say, yes, the market is not up as much during that 6-month time frame, but it's still up. So, and you never know when it's going to be up more, that 6-month time frame versus any other time frame.
And I think, Steve, didn't we have a statistic the other day that over the last 10 years, 70% of the time, that would have been a wrong decision?
Yeah.
Because the market has done well in the summer. So it's too hard to time that, get in, get out. If you're a non-retirement accounts and you have cap gains, it's better just to maybe not look at your statements and enjoy the summer.
Yeah. Investing based on the calendar isn't really an investing strategy.
Right.
Yeah.
Any other questions?
Come on, you got Kerry on here. You don't get Kerry's attention very often. Let's ask some questions.
I have a short attention.
Another thing, like you keep saying that housing seems to be okay, and then I was listening to a story this morning about home insurance and how, I mean, just even, it's not just California, it's not just Florida anymore, but there's this like small town in Iowa that can't get insurance, and they're saying that for every dollar coming in, they're spending about $1.25 or $1.50 on insurance costs. I mean, and I was just talking to a client who her home, when she was selling it, almost fell through escrow because the person buying it couldn't get insurance. Yeah. And so at what point yes, there's a huge supply, but if we can't get insurance, we can't get mortgages, where do we start to see some cracks in this system? What could happen?
Yeah, that's a conundrum. In fact, we were talking to a client yesterday, I think Quentin and I, and he just decided not to renew his insurance. He had that ability because he didn't owe any money on his house, so he could let that insurance lapse. Quentin lives kind of nearby that person, and I think Quentin said that his insurance has gone from $2,000 when you bought the house to about $6,000 in premiums today, maybe in a 3 or so year period. So I definitely could see this as a problem, and it's a big problem in Florida with even the condos and the HOAs, that all of a sudden these buildings that are over 30 years of age, they're being mandated by the state to recertify the structures because of what happened. And condo residents are getting, huge assessments, $100,000, $150,000 that people can't afford. And so now what's happening is, because nobody wants to buy these places with that kind of a potential liability, so condos that were selling for $300,000 or $400,000 2 or 3 years ago are now $200,000, because of these big hits. So I could definitely see that, and it'll be interesting to see if, the government does anything. But on defense of the insurers, one of the reasons it's costing so much is if you were to go out and renovate your house today or build a new house today, it's going to cost you a lot more than it would have just 5 or 10 years ago because of labor, raw materials, and all the other things, city inspections and whatnot. So what's happening is, if your house burns down, it's costing the insurance company a lot more, to fix your house, to fix that plumbing leak. And so what they're having to do is raise the premiums to cover the cost. So I don't necessarily believe they're out there trying to gouge consumers. It just costs a lot more to get your car repaired, to get your house fixed, and all those other things. Yeah. And ultimately, it's definitely going to be a problem, because if people that live in areas that are more prone to fires, they might have to look for an all cash buyer, because no person that needed to get the mortgage could find the insurance to close the deal. So those people, you might see prices decline. And that could be the needle that pricks this. I don't know. Good question.
Yeah, I don't think we're in that where we were in 2020 or 2021, where we had a lot of all cash buyers.
Right.
I feel like that market, or that, I guess, customer is really, they're situated and they're not probably leaving.
Yeah.
California does have an example of this happening in the past too. So in was it 1989 when the large earthquake was, or 1980? it was in the 1980s, there was a massive earthquake in California.
Silmar.
And
Mhm.
yeah, and that's when earthquake insurance became a deal here. And it almost collapsed the housing market in specifically California because nobody could get insurance and whatnot. There was nobody who wanted to cover it because of the cost that they had in that experience. So, you know, housing prices did decline in California and made in specific areas, the closer obviously you are to the fault line and whatnot. So could have a repeat, kind of a little bit of history showing us what could happen.
Yeah, and I think you're seeing this not just in housing insurance, right? But also in car insurance. Car insurance is costing a lot more. And again, it's not necessarily because I think they're trying to gouge. Just go take your car to the, Caliber collision, and you're finding it's going to cost you a lot more to get your parts and your labor and everything else. I think someone told me the other day they took their RV over to a place here in Redlands, and their labor rate was like $200 and something an hour. I mean, it's really gotten very expensive out there. Now let's leave on a positive note. Let's find something
I
positive.
don't, Jim, do you have a question? You unmuted yourself.
Oh, let's see. I see Jim is crying over here. Right. No, but I think, like I said,
Jim has a
2024 is
question
going to
too.
be a good year. And I see Jim has his hand raised.
Yeah, go for it, Jim.
I don't know if this is a question or just a layman's ignorant comments. We keep talking about inflation, we keep talking about interest rates, and I recall back in the 1980s when I had bought my house, rates were like 14%, 15%, and headed up to 19%. And everybody was panicking, including myself. Well, now I've gotten older, I find, people just adapt. They adapt. The milk is $2 a gallon, maybe in 1980, but now it's $5 a gallon currently.
Right.
So we're such an adaptable society that what I care about is you guys. I want you to react the financial side of it and let me keep getting my check and let me worry about what I buy.
Right.
I don't have the time in my life span to worry too far out in the future. I just worry about making the next day. Yeah. So I think society's very adaptable to inflation. We talk about inflation. I would venture to say that 90% of the people on the street could not tell you what inflation really is.
Yeah.
So I think sometime we got to sit back, try to put things in perspective. And like I said, I let you worry about the finances and let me about live an everyday life. So right. That's kind of an optimistic, negative comment, but I just feel that it's current.
Well, Jim, I've known you a long time, and I don't worry as much as I try to make sure that we do proactive thinking and implementation. And I would say this, and this is why I've been a bigger preacher of equities over fixed income, is I have probably more confidence in corporate America than I do in the government. And I don't mean that in a negative way, but the government spends more money they run deficits all the time. They've never met a payroll. And corporate America has to continue to innovate, create, and build products that you and I will want in the future. And they don't have the opportunity to print money. They have to stay in business. And so I believe in that entrepreneurial spirit. And the good news is in equities, companies have the ability to have pricing power. Right. So if prices are rising, what they have or labor's rising or the raw materials are rising, what they do is they raise their prices. And the reason they raise their prices is to protect that profit margin. That profit margin protects our stock price. So companies are adapting. Now they have to be careful because if they raise prices too high and they don't have a product that people want, they're going to go out of business. But I have more confidence in corporate America to innovate, create, and adapt more so than, again, not to be mean to the government, but I just have more faith there. And so that's the way we can keep up with times. And so those charts that you saw going back to the 80s, inflation, wars, presidential attacks and this temps, all these things, the market's volatile, but you just still averaged 11%. And that outperformed inflation. So sometimes you just have to take some of that volatility as part of the package. And when it gets really bad, don't open your statements. I know that sounds naive or kind of pious, but no, that's what's the best thing to do.
And like, go ahead.
I
Jim.
agree with what you just said. I just feel like we all listen to probably or watch Fox News and CNN, and every day it's a different problem. One day it's Joe Biden still sleeping at the wheel. Next day it's a newcomer on the scene that's just did something that's inappropriate. But life goes on.
Yep.
I want to complain, but I don't want to live in a complaining society every day of my life.
Right.
The corporate America, they do what they do. And then what happens is unions and them do what they do. Okay, I don't want 8% increase. I want 24% increase. So it's like a continual circle. I'm just saying you got to hone in on the things that you are expertise in. Like you're the expert, in my opinion, in portfolios, finance. I don't even look at my statement maybe on a quarterly basis or when I'm getting ready to have a call from you to act like I know what I'm talking about. But
Right.
generally speaking, you've got to live life and you can't worry every day about what's happening in corporate America or on the streets, or why you'll go insane. And you'll get old really fast. Like I see you got a lot of gray hair and a gray beard now. And I'm just hoping that's just time and shade, but
Wisdom.
not necessarily time and loss.
Right. Yeah.
Jim, you sound like an ideal client. That's all I'll say.
Hey, we got one more question. I think it's from Tom. Any concern with the talk of currency change coming?
Yeah, I think that no, I don't. I mean, I'm not a believer of the crypto. I speak about the government and I say, you know what, they can't balance their budget. They're way in debt, but at least they own national parks and they have a taxing authority over the people and they have government buildings. So as weak as it may be, the government and backing up the dollar is more than nothing, which is backing up crypto. Crypto is just, you know what, the bigger fool theory. Now I know it's gone up and probably I might have missed it. I just don't get it. It doesn't make sense. You have nothing and you have the bigger fool theory. Well, if I buy it at 30,000, maybe somebody's willing to pay 40. And it has been very volatile. It's gone all over the map. But no, I don't have any fear of, the dollar at this point. Still the reserve currency of the world.
Yeah, I'm not sure what currency. I mean, it could be crypto, could be something else, but where do I was just talking about this with a client. Where do when immigration happens for the most part, where do immigrants want to come to? They want to come to America. They want to come to this country. America is a place where the world, maybe some countries don't, but for the majority of countries out there, they believe in America as the kind of the leader,
land of opportunity.
People
can come here and build. We had a little interview with a person yesterday that wants a job, and she came from Vietnam in 1975 or 80. She couldn't speak English. She learned how to speak English, and the immigrants often, sorry for the white Caucasians on the line, but they often want to work harder than the rest of us, right? They're spoiled. I mean, we're spoiled, and they look at this like, wow, what an opportunity that I have. Elon Musk, he's from South Africa. Where'd he come to start a company? He came to the US. So I think we're still the envy of the world. It's troubling to hear some of the news and some of the things going on. But I still think when you look around the globe, this is still a pretty good place to be.
Yeah, so that addresses the a different reserve currency.
Yeah.
And then as far as crypto goes, when you sell your crypto, what do you get? What do you buy? What do you have to get to buy something? Yeah, to buy something.
Right.
What do you have to
and
get
when
to
you
buy
sell your
something?
gold, what are you getting?
Yeah, right.
Dollars.
Yeah.
Right. And people that are selling, they're always saying you need to buy gold to protect your dollars, but what are they taking when they sell you gold?
Yeah.
Your dollars.
Right. So
Yeah.
just
Anyway.
an interesting note.
Right.
I agree with Kerry. I don't have any opinion on it other than to say that I think the dollar is and will be the reserve currency for a very, very long time.
Yeah, I remember there was talk about it was like Brazil, China, I forget what the acronym was for those countries that
The
were.
BRICS.
The Brits, yeah, trying to separate from the US reserve currency. But then back in earlier this year, a couple months, I think it was March, China had purchased the most that they had ever had into US reserves. So buying US dollars. And I think, for them, they're always their market is volatile, right? They're trying to do some things to manipulate their currency. But really, they can't move away unless other countries start to want to actually purchase yen, and nobody wants to purchase, or it's yuan, I guess, huh? Yeah, and that's not happening yet. Probably won't happen.
All right, you guys, I want to say thank you for tuning in, and it's always a pleasure to see all of you. And I see some faces that are newer and some older ones, and thanks for having confidence in us. We really enjoy working with you. We really appreciate you guys, and thanks for hanging in with us all these years.
Yeah. Thanks everybody. Thanks for joining us.
Yeah, thanks. Have a great rest of your day.
Thank you.
Take care.
Thank you.
Bye.
Thanks. Have a great day.
You too.
Thanks.